Warren Buffett called his last book a rarity in its usefulness. My copy of his new book, Mastering the Market Cycle, Getting the Odds on Your Side, is already dog-eared, which means it won't become like anything to prop a door open or something you put a cup on. Joining us right now, we've got Howard Marks. He's the co-chairman of Oak Tree Capital, which manages over $120 billion in assets. He joins us now. Hello.
Thank you, Jen. Nice to be here.
Yeah, great to have you. So, mastering the market cycle, what is the difference between mastering the market cycle and timing the market?
I think timing the market is guessing at what's going to happen tomorrow. In my opinion, the key to mastering the market cycle is understanding where it is today. We never know what's going to happen tomorrow, and the people who think they do tend to screw up. But if we have a sense for where it is, we know something about the probability distribution of returns that we're facing, and I think that's about the best we can do.
So with regards to the future, I guess, in your most recent memo, you expressed some caution, I think, on the overall market. Can you just outline some of your thinking right now, and what are maybe the biggest red flags that you're seeing across assets?
Sure. Well, I like your use of the phrase across assets because these factors affect basically everything. When I've been doing this 50 years, and when I've seen booms, invariably, they were characterized by three things: too much optimism, too little risk aversion and caution, too much money chasing too few ideas. And to some extent, those things are present today, so it's time to start thinking about caution.
Can you talk about a few areas, I suppose, where, as you call them, the 7 most dangerous words in investing are most present? And I think what's interesting is also in that most recent memo you put out last week, you know, I wouldn't say sanguine on the equity markets, but certainly not the red flag we're seeing perhaps in some debt markets.
Yeah, I think that, you know, in recent years, not a lot of money has been flowing into equities. A lot has been flowing into debt. People like the idea of having a debt instrument which is going to pay interest and then give you your money back at a point in time. They are assured by that, so that makes the money flow in. When the money flows in, that means the buyers at the auction have more money to spend, and that tends to put the prices up. And with securities, price up, future return down, safety down, risk up. So credit is an idea. I want to borrow some money. Jen says, I want 5%. You say, I'll take 4. I say, I'll take 3. You say you need a full set of covenants. You say, I don't need many covenants. I say, I'll take it without covenants. I get to make a 3% covenant-light loan, and I'm the winner of the or am I the loser? Right. That's the key. And this is a process I call the race to the bottom. I wrote a memo by that title back in February '07.
Famous memo.
And to some extent, it's happening now.
So, I mean, as you say, or you quote a lot, you know, history doesn't repeat itself, it rhymes.
Right.
Maybe Mark Twain said that.
Yes.
So right now you've also written that it appears that debt instruments are going to be found at ground zero when things go wrong this time. You know, we've been talking about leveraged loans. They seem like the new boogeyman on Wall Street. Yes. What do you think of them? Well,
I mean, that's the key for you and your viewers and everybody to understand is that there's no such thing as a good idea or a bad idea until we can talk about price. It's not what you buy, I always say, it's what you pay. So I think that leveraged loans are a great idea. They pay interest, they repay principal, they're senior in the issuers, and they are generally tied to floating rate loans so you don't have interest rate risk. All good things. At what price? And no matter how good the merits are, it's possible for things to become overpriced. When money is flowing in strongly and it is to leveraged loans, then they can become overpriced, and some are.
What's the average investor, though, to do? I mean, parts of it, I read the book and I'm like, I got to go under the desk here and move to cash.
You already have that.
No, I don't want you to go under the desk, and I don't want you to move to cash.
So, yeah, what should I do? Because it's scary sometimes when you go through this and you hear, oh my gosh, he thinks we're in this really bad time.
Let me set the scene. There are 2 risks in investing: the risk of losing money and the risk of missing opportunity. You can eliminate either one, but it puts you firmly in the crosshairs of the other, or you can balance the 2. How should you balance them at this time? Should you worry more about losing money or worry more about missing opportunity? And I would say the former. So the point is, I'm not saying get out of the market. I'm not saying go to cash. I'm not saying this is the worst thing I've ever seen. I'm just saying I would emphasize caution to avoid losses over aggressiveness and the risk of missing out. So what does that mean? Anything you want to do in the investment business, invest in stocks, bonds, loans, mutual funds, money managers, whatever it might be, you can do it aggressively or you can do it defensively. And I think today is a time to overweight defense. Not to go entirely toward defense. That means, as you say, cash, get out of the market. I'm not suggesting that. We're not doing that. I don't think anybody should do it unless they are hypersensitive to losses. But I do think that this is a time for caution.
So to go back to a hot sector, or not really a sector, stocks in the stock market,
Yes.
the FANG names. Last year
Yes.
you were writing about them and said, they may well be the winners of tomorrow.
Yes.
But you also said, given human nature, the best will eventually become to be overpriced,
Right.
even if they have great fundamentals. So
That's right.
have you changed or updated your thinking on those names, or does the story really remain the same? Some of these stocks have doubled since you wrote that memo.
I wish you wouldn't say that, Myles. But, the truth of the matter is that, I wasn't picky on the FANGs. I'm not an expert. We don't invest in the stock market at Oaktree. What I was saying is that the willingness of people to highly value companies, not based on their present assets, but based on their long-term potential, is indicative of optimism, faith, risk tolerance. My book is all about knowing what's going on in the market, and that is an example. That's all, just an example. Now, many of the FANGs have had some severe hiccups.
Yes. Facebook.
in the last 9 months, and if somebody owned them, and then they gap down 20%, and they lose faith and sell, that's dangerous. So the point is, you have to assess and control the risk in your portfolio.
So you like to draw this.
I do draw.
The market cycle. And I'm just wondering, have the Trump tax cuts at all changed, what's happening with your drawing?
Let me say one thing. Go back 2 years. There were two things everybody was sure of. Trump would lose, but if perchance he won, the market would collapse. So Trump won, and the market went up. That should convince everybody, as it has me, that we don't know what the future holds. And we don't know what's going to happen, and we don't know how the market's going to react to what happens. But as to your question, the tax cut is very stimulative. It was very popular with business, and it is causing company profits to expand. So that's good. There are two questions. Number one, no matter how good things go, they can become overpriced. Has that happened? Will that happen? And number two, since it is stimulative to an already healthy economy, it raises the risk of the economy overheating, bringing on higher inflation, causing the Fed to raise interest rates even more to cool it off, and that will hurt some indebted companies. So, the interesting thing in investing is that everything has two sides.
That's the problem, but you don't know. I just want the answer.
Well,
but it doesn't seem like there are two sides of it. And then sometimes you say on one hand, on the other hand, and
Exactly.
then sometimes you say on the third hand. So
And
I don't know what to do.
Good. Well, then I'm communicating clearly. Charlie Munger, Warren Buffett's partner, said to me when I was completing my last book, and in time to get it in the book, he says, none of this is meant to be easy, and anybody who thinks it's easy is stupid. We're talking about making money. Everybody wants to make money. It's highly competitive. Why should it be easy?
Real quick, we just had the Alphabet chairman here, John Hennessy, with his book. He had pages of recommendations of books he read. You read a lot, and you write about that in here. What are you reading right now?
I'm reading a book called Factfulness, which encourages people not to respond to what's going on emotionally, but to be analytical, seek out the truth, overcome the bias of panicking, and be factual. And I think it's a great book.
All right, we'll look into it. If Myles and I read it, can we have a book club?
We can.
Okay, fantastic. I love it. Howard Marks, he's the author of the new book, Mastering the Market Cycle, Getting the Odds on Your Side. Thank you so much for coming by. Fascinating to talk with you. Of course, we read your memos, and so it's really fun to have you here.
Thank you for having me.